Welcome back to the DD guys. You got Bert and Lanny repping the dividend diplomats here, straight flexing. You know it. Today's going to be a little bit interesting.
Hmm.
Could get a little bit risky. You don't know what's going to come out behind the curtain here on today's video, Jack.
Let's do it. But before we pull that curtain back, subscribe to the channel. Give this video a thumbs up. So this is going to be a fun one. We've never had this style of video before. It's going to
No,
be
we haven't.
exciting.
Unfortunately,
No, we haven't.
unfortunately.
See the smile here. We're excited. You can tell. Let's just get right into it, Lanny. What are we talking about today?
Well, guys, we're going to talk about four dividend stocks, but not four dividend stocks to buy right now. Four dividend stocks on the watch list. Well, hey, maybe you are a buyer. Maybe you
Yeah,
were a
yeah,
buyer. I
maybe.
know Bert's been a buyer of one of these
Uh.
stocks. Maybe you are a buyer. This is nothing against being a buyer of these stocks because they have proven time and time again, at least three out of the four have, that they're here to pay you and increase dividends. Today's video,
75% of them have proven that they
so
have.
guys, today's video is about four stocks, and do you think there's a risk of a dividend cut here? So we'll give our take if we feel like there's a dividend cut looming on these four stocks. We're going through some interesting metrics. We're not going to look at price to earnings ratios. We're not going to look at 52-week performances or 5-year average. That's not the point. We're looking at payout ratios, the levels of debt, how long they've been increasing their dividend, and at what rate.
Let's do it, everybody. So remember, we're going to talk through four stocks. I think between our full family portfolios, I know I own all four of them. And so do you. All right,
I
we
smile like there's
We
nothing
did
wrong.
it. We did it. Yes. All right. So let's talk through this first one here because this is going to be fun because we're looking at are they companies going to cut their dividend? Whew, this will be an interesting one. Who is company numero uno, Lanny?
Numero uno is the Hogan leg drop, Leggett Platt. Ticker
Yeah.
symbol is LEG, the dividend king that yields over 6%, Bert. And I know you've been buying Leggett and Platt in particular. So, what do the metrics look like? How do you feel? And you got to be the first one to say what your take is.
I have been buying Leggett Platt because I wanted to get over 200 shares. So I have a vested interest in this one. I'm going to be a little pissed off if there is a dividend cut on this one, but we'll unbiasedly look through some of the numbers here. If you go through their annual dividend right now is $1.84. Now remember, I'm gonna explain this one to everybody. For you to have a payout ratio less than 100%, earnings per share has to be higher than the dividend. So the earnings per share needs to be greater than $1.84. It could be $1.85. It'd be below 100%. Well, getting plots forward EPS for this year, $1.63. That makes it a payout ratio of 112%, or almost rounded up to 113%. We can't forget that extra percent now, can we? Can we, Lanny?
I
So
mean, I own them too, so it's not that
yeah,
funny.
no, it's not funny, but I've been buying them, and it's a very fair question to ask. Are you concerned about the dividend? And
50 plus years, man.
yeah, they just announced a dividend increase too. They just announced a small dividend increase,
No,
but
it wasn't.
it was a 4.5% dividend increase. So I guess you could say that wasn't small. I'll give you that, Lanny. I will give you that. It wasn't a large, but my take on this is you wouldn't think you would announce a 4.5% dividend increase if you were getting ready to announce a dividend cut.
You wouldn't do the Kinder Morgan move.
Yeah, so when I started looking back, we did a video on Leggett Platt a couple months ago. So I'm going a little bit off memory on some of these pieces here. Their forward EPS after they get through what's going to be a tough 2023, their forward EPS is $1.81. So just a hair below, still above 100%, but it's manageable. The big piece is, though, the debt. And that's the conversation of why people think there could be a dividend cut. Their long-term debt is $2.1 billion. Their long-term debt at year-end is going to be just a little bit under. But why I liked Leggett and Platt so much that I wanted to keep buying was they have a unique aspect about their debt. Their cash flow, they don't have any debt maturities coming up here. It's all interest payments, at least through the end of 2024, 2025. Someone can fact check me on when those start again. So they're managing their current cash flow a little bit better because they don't have a massive debt payment, a debt bomb that's going to be coming through to their cash flow. And that's why I personally don't believe there's going to be a cut in 2023. That's my disclaimer. 2023. I'm not saying 2024 if things don't get better. That's a different story. What do you think, Laney?
Yeah, I don't know. I think it's tough. I mean, because Leggett Platt, they build all the springs and and the seats and beds, right, Bert?
Yes, that's absolutely right. They're in office furniture. They're in all sorts of different components there. And let me tell you let me tell you about the office furniture market right now. Yeah. I'm not joking because I just had to liquidate a lot of office furniture for my company where I work. So I could tell you there's not a robust market for new furniture that Leggett Platt will be selling to.
How about this? On the 1 to 10 scale, 10 they're going to cut, 1 they're absolutely not. I'm at like a 5. I'm just not sure. I'm not going to buy Leggett Platt right now because I'm not sure.
Yeah, I'll give him a 3. That's reminded us, I got him at 200 shares. I'm at 200. So I don't really think
300.
Yeah. I don't feel the need to do more, but I think I'm good for now on the Leggett Platt. I'm going to look elsewhere and we'll see where life takes us.
Yeah, I'll let it drip, but yeah, I'm gonna have a little bit higher of a risk factor now just based on the increase in long-term debt, payout ratio. You can't sustain an above 100% ratio for too long, and then you just ease into equity.
You're right. I think
I have been fooled. I have been fooled multiple times.
Yeah. So speaking of companies, let's move to number 2. That was a terrible segue. My segues are off right now.
Let's go. Walgreens Boots Alliance, ticker symbol is WBA. Obviously, they're getting a lot of backlash on declines in revenue. Obviously, their stores, et cetera, et cetera. They've been plummeted down to about 19% down this year as the timing of this video on July 20th, trading at $30.24. Now, forward projections are $4.01, and they pay $1.92 per share per year. So actually, they have a below a 48% dividend payout ratio still here. Now, granted, their dividend growth is pretty much like, a business. It's like negligible. It's just not even anything to write home about. But they've been growing the dividend for 46 years. They inched it up again this year, barely. I don't know. Long-term debt's down by almost $2 billion from year end to now. So.
Yeah. I mean, it's interesting here though with Walgreens because their earnings were not great, and they announced a lot of store closures. They're reducing expenses significantly, and I don't know why. Just me personally, I feel worse about Walgreens than I do about Leggett Platt, which I think is kind of funny to me because I think they're in the stages of trying to figure out how they're going to maintain the cash flow, like their earnings and their cash flows to sustain the dividend. I don't know if that's the end goal, but they're in aggressive cost cutting mode right now. So to me, that increases the risk factor a little bit.
Yeah, I'm probably at a 4, maybe a little bit. For me, I'm a little bit lower risk than Leggett Platt simply because they have the earnings right now to at least support it, even though earnings isn't everything, guys. I mean, heard from Bert. Look at many other companies. Look at AT&T. Look at others that manage it based off of operating cash flows.
Intel cut their dividend when they did. Well, Intel didn't. They still had some room on their payout ratio, but they did like a preemptive cut. That was the analogy I was going. Yeah. Might not have been quite as low of a payout ratio.
Yeah. But again, similar to though, I'm not buying Walgreens either.
No, I'm not either. I'm holding, I'm watching. I want to see a little bit more of what's going on. I didn't give my number, so I'm going to put them at a 5, I think, for the risk factor. So still kind of.
I think what made it better for me, I think, is that they are aggressively cost cutting and their long-term debt has been declining. And I'm curious to see what the next quarter looks like. I mean, the payout ratio for me.
Yeah, let's do it. So that's 2. We've gone through Leggett Platt and Walgreens. All right, everyone. I bet you didn't think we were going to make it this long before we talked about Verizon, ticker symbol VZ. Let's talk about Big Red here in the telecom sector. So Verizon's now telecom's just been beaten. There's really nothing more to say for it. Verizon, AT&T have just been destroyed over the last couple of weeks. Their price is now $33.64.
A couple of years.
Yeah, years, but really over the last weeks, they were just like it was like when Undertaker just keeps tombstoning them over. Or maybe it's more Brock Lesnar suplexes. They're stuck in suplex city right now, just getting destroyed. Their price is $33.64. Their annual dividend is $2.61. Their EPS, forward EPS is $4.68. So their payout ratio is still 55%. But I don't think Mr. Market thinks their payout ratio is at 55 cents based on how their stock price is falling. And Lanny, how long have they been increasing that dividend for?
18 plus years. So they're on that path to being a dividend aristocrat, unfortunately. So it's almost like they can't give that up. I say it unfortunately because now they get that oh, we got to keep going. Somewhere, I think Leg just crossed that 50 years. So they're like, we got to do it.
You can't take it away from us that we made it into the peak dividend king.
but big red Verizon stock here, guys. Long-term debt has kind of stayed the same. Obviously, that's how telecom grows. And that's the one negative part when you're dealing with high interest rates. Hey, during the pandemic, when interest rates are non-existent, go ahead, borrow to grow. But when you're borrowing now at, commercial rates at 5, 6, 7, 8+%, 9,
I'm sure
10,
for their rated bonds, it's got to be much higher. Though that's not cheap debt right
now. Yeah. So, that's tough. Tough to expand your network, tough to merge and acquire. Obviously you got to pass increases on to the consumer, which I don't know if they really have done yet. So I could see they better be managing some costs to get cash flow to be solid.
Yeah, and that's really what the concern is, and that's why they continue to get punished. And their yield's at 7.76% now. It's up there. It's getting high. And I mean, I don't really know what more to say about the sector right now. We've watched this once with AT&T before where the yield starts climbing and eventually the math doesn't add up. It was a much different circumstance for AT&T at the time. Don't get me wrong. It was a completely different circumstance, but at a certain point, the math begins to tell you something, even if the payout ratio hasn't caught up to it yet, that there might be an earnings surprise, or let me say this, earnings miss surprise that might happen that could cause chaos amongst Verizon. So I'm going to put this risk higher. I might say 6 or 7. I think the telecom sector is one to watch out for a potential dividend cut.
Yeah. I'm going to, only because it's hard to do apples to apples with what AT&T had to do X amount of years ago when they spun off, because they spun off a lot of the cash flow. When you think about it, they spun that off. They spun out revenue and cash flow. So they use that as an opportunity to right size their dividend, because there's no way the dividend should have stayed the same when you lose a chunk of your business to Warner Media Discovery and DirecTV. Verizon's not doing any of that. And, I'm going to rate this again a 5, similar to Leggett Platt, because long-term debt has stayed the same. And I haven't heard too much news about cost-cutting strategy to save on cash flow. Payout ratio is fine. Yeah. So that's why it's not a 6 for me, but I think just because the level of debt, $141 billion, is a lot of debt to have on your balance sheet.
Yeah, and I would agree with that too. I could see easily there. I just think it's slightly higher because I think there could be there might be another shoe to fall that just might not be there yet. So that's why, and if it is, sector's there. So let's move on to number 4. Their rival AT&T, ticker symbol T. We're going there, everybody. We are going there. They're like, hey, you first 3. You're talking about your first dividend cut. I'm here talking about my second dividend cut. Yeah, repeat customer.
Play my Bischoff music. I'm back.
I've been through that. Airbus, so AT&T trading at 14.66. They said the lowest in 28 years, 29 years for AT&T. Their annual dividend after that first cut's $1.11. Forward EPS 242. That gives you a payout ratio of 45.87%.
Lowest among the group.
Lowest. Oh, look at them. Look at AT&T go. Let's just go to the debt because there is no dividend history right now. Long-term debt's $123 billion, 123 billion. A year end, it was 128. So they're paying down debt slowly. They're seeing some decrease in debt, which you didn't necessarily see for Verizon.
Which is what they, had intentions to do to open up cash flow.
Yeah. So the question is, Lanny, what do you think about AT&T's dividend here? Where do you put them in the risk
They
map?
they yield as much as Verizon, 7.57%, down 21% this year. I think they absolutely have to do everything in their power to avoid it. In fact, I'm actually only giving this rating a 3 on AT&T.
I like it. I like it. I'm going to give them a 5. Same reason why I was a little heightened on Verizon, but lesser for the reasons of what you said. They have to avoid it. AT&T cannot go into 2 dividend cuts in years. That would be catastrophic for the company. So
yeah, they would lose all confidence, guys. I'm talking you would have activists, out the wazoo.
yeah.
Under 50% payout ratio. Plus, the reason why it's not where Verizon was at a 5 and it's at a 3, lower long-term debt, below a 50% payout ratio, and then the stigma of, hey, you just reduced it because of the spin-offs.
You just made me think of, though. We've talked about aggressive cost cutting. I have AT&T right now. You don't know what they did to get some cash in? They just sent out an email. I can't remember when they're doing it, but they said that they are decreasing the paperless billing discount from $10 a month to $5 per month. So they're looking for ways to get more cash in the door, which not a bad thing. It was a very aggressive and nice discount, but $5 would probably also do. So they're looking for it.
Yeah. Wow. Look at that. That's great.
Yeah, no, like for a shareholder, great. For a person who is paying for the cell phone bill, not so. But all right, so there we are, the 4 companies: Leggett, Walgreens, Verizon, and AT&T. We haven't explicitly said, are we buying all 4 of them? We've talked about a few of them. Rapid fire, Lanny, are you buying any of these companies right now?
No. Dripping, holding and dripping.
Same. I have nothing more to say. Everyone, let us know what you think. How many of these do you think are going to cut their dividend, if any? Let us know in that comment section below. Please also let us know too. Are you buying, or are you just holding, dripping, or have you turned the drip off for these companies? Are you moving the funds elsewhere? Let us know.
Hey guys, if you haven't, again, subscribe, like the video, and just remember, you're either with us or you're against us, Jack. That was Bert and Lanny from the Dividend Diplomats, over and out.